What is up, everyone? Today I'm going to be giving a quick rundown on why I think that the stock market is completely overvalued and you should not be purchasing any long-term investments right now. To start off, we need to discuss what is the GDP? The GDP is the gross domestic product, and it is a monetary measurement of the market's value of all the final goods and services produced in a specific time period. We also need to consider what is market capitalization. Market capitalization, commonly called market cap, is the market value of a publicly traded company's outstanding shares. In this given situation, we are going to be looking at the market capitalization of the entire US stock market versus the US GDP. So, what is a healthy market cap versus GDP ratio? Okay, so the average market cap to GDP is 75%, meaning that the market cap of the stock market is 3 to 4, 4 being the GDP. And many believe that over 100 indicates that the market is overvalued, while others believe that the new normal is closer to 100. When it says 100% in this situation, that means that the GDP and the market cap are equal. So, let's go over this. What is the current GDP of America in the fourth quarter of 2020? The fourth quarter of 2020, the GDP of America was $21 trillion. Now, let's take a look at what is the current market cap. So, as of today, the total market index is at 41 trillion, which is about 192% of the last reported GDP. Now remember, we are looking for something that is about equal. We are nowhere near equal. 41 trillion versus 21 trillion. Now let's look into something really quick. What was the market cap of the GDP, market cap versus the GDP in 1929, the stock market crash that caused the Great Depression? In September 1929, the market cap of stocks listed in the U.S. Stock market reached 125 billion, while the nominal GDP was at 106 billion. So, this is about 120%. Nowhere near the 192% that we are sitting at right now. According to the Buffett indicator, the US stock market is positioned for an average annualized return of minus 2.9%, estimated from historical valuations of the stock market. This includes the returns of dividends currently yielding 1.49%. So that means that it'll actually be a little bit more dramatic. So let's look at some charts here. This is the S&P 500 versus the GDP on a 100-year scale. As you can see, for the last 5 years, the red line being the growth of the S&P 500 and the black line being the GDP, the S&P 500's growth completely becomes detached from the GDP. This is a big problem because the stock market commonly crashes whenever the GDP is a lot lower than the market capitalization. Let's look at one more chart here. This is the S&P 500 to GDP ratio. Here you can see the dot-com bubble in 2000. Here you can see the market crash of 2008. And now you can see right now. As you can see, the GDP versus the market capitalization of this S&P 500 is completely disproportional compared to the market crashes of 2000 and 2008. In fact, we are at the highest level since 1940, around the Great Depression. I think that this is extremely alarming, and you should not be buying long-term investments right now. Guys, I don't mean to scare you. I don't think the stock market is going to crash anytime soon. But if you are going long on the stock market, you should not be buying your long-term stocks right now because we are going to be in a long, slow downtrend unless we have one big crash to set it all off. Everyone knows that there has been a lot going on in the U.S. economy right now. Everyone knows that the stock market is completely disproportional from the economy. This is not normal. This cannot sustain itself. We're not just going to keep on going up forever. All I'm saying is be careful, do your due diligence, play it safe, make your money in the short term, but be ready because something is coming. Something is coming for sure. Thank you for tuning in. I hope you have a great day and have a good time trading.